A very warm welcome to you. Thank you for joining me today. I'm William, Product Manager for Iron Ore at the Singapore Exchange. Today, I will be speaking about iron ore derivatives, our flagship commodity products at SGX. In the last few years, iron ore volumes have grown from strength to strength, and last year we cleared a total of 4.4 billion metric ton, representing nearly 3 times the underlying seaborne iron ore market. In the next few slides, I will share with you why many are interested in iron ore derivatives as the product evolves from a hedging tool for market participants with exposure to the underlying iron ore market to a trading and investing instruments for non-physical market participants, thus diversifying the market participant base further. But first, let's take a quick look at the SGX Commodities product shelf. SGX Commodities product offerings can be broadly grouped into 3 thematic pillars. The first pillar is called Virtual Steel Mill, which cover bulk commodity derivatives such as iron ore, steel, and coal. Coal includes both coking coal, which is used in the steel production, as well as thermal coal, which is used in power generation. For iron ore, we have derivatives for different grades of iron ore, from the lower grade 58%, the benchmark grade 62%, to the higher grade 65%. Iron ore derivative volumes are now nearly 3 times the underlying seaborne iron ore market at 4.4 billion metric ton, and SGX clears nearly 100% of the seaborne iron ore derivative market. So that's the first pillar on virtual steel mill. I will come back in a second on the second pillar, freight, but let me talk about the third pillar first, the virtual electric vehicle. Under this pillar, we have derivative products for commodities that are used in the production of the components of an electric vehicle such as rubber, energy metals, and petrochemicals. Rubber is the feedstock for the production of tires, while energy metals such as cobalt and lithium are the main components of EV batteries. Last but not least, petrochemicals are used to produce plastics, fiber, and other parts of EV cars. SGX Cycom rubber is a global pricing benchmark for natural rubber, with seaborne market share of 80%. We cleared 30 million metric ton of rubber last year. Now back to the second pillar, freight. And under this pillar, we have freight derivative products covering dry bulk, container, and the LNG freight markets. The freight pillar is central to our commodity product offerings, since 90% of commodities are transported from the suppliers to the buyers via ships. So that's the 3 main pillars that we have. And concluding this slide is our dairy product offerings, a collaboration with the New Zealand Exchange, where we migrated the listing of dairy derivative products from NZX to SGX to grow the products further. In the next few slides, I will now focus my presentation on iron ore, starting with this slide which shows the virtual steel mill pillar. In the middle portion of the slide, there is a simple diagram showing the primary steel production process, which typically comprises of 2 steps, the iron making and the steel making. The conventional iron making process involves a blast furnace, while the conventional steel making process uses basic oxygen furnace. In the blast furnace, iron ore, coke, and limestone are heated to produce molten pig iron. The carbon-rich molten pig iron will then be mixed with scrap steel in the basic oxygen furnace, and oxygen is blown through the mixture to reduce the carbon content and convert it into steel. At the top of the slide, I have listed the derivative products of the bulk commodities used in the steel production process shown below, from iron ore, coking coal to thermal coal. At the bottom of these slides, I have also included our dry bulk freight products, as dry bulk ships are used in the transportation of iron ore and coal from the miners to the steel mills. Together, all these products make up our virtual steel mill product offerings. In this slide, we will see why iron ore is a proxy for China's growth. Given that iron ore is a key input in the steel production, where steel is the most important metal in modern civilization and is key to urbanization, iron ore is a proxy for China's economic growth as China's urbanization continues apace in the last decades or so. The charts show iron ore's close correlations with China's cyclical activity tracker, Chinese imports, and Chinese PMI numbers. It can be argued that iron ore is not only a micro indicator for China's growth, but also for growth across the globe, given that half of the world is yet to urbanize. Typically, demand for iron ore will fluctuate in line with the steel demand from 3 key sectors: property, infrastructure, and manufacturing. In this slide, we see that iron ore status as a global macro indicator continues to rise, and it has increasingly attracted interest from various market participants, not only as a hedging or trading tool, but also as an investment product itself. The chart on the top shows iron ore, represented by the S&P GSAI Iron Ore Index, has outperformed other key GSAI commodity index since 2017. With persistent backwardation in the iron ore forward curve, iron ore has a consistent positive roll return. In 2023, iron ore total returns was 45%, with a roll returns of 24%. Iron ore is the second largest commodity by weight and value behind crude oil, making iron ore truly Asia's first global commodity. Average daily volume for iron ore in 2024 is over 200,000 lots, equating to around 2 billion daily notional. The pie charts on the right shows the increasingly diverse participant base in the iron ore market, with financial market participants making up over 50%, including market makers. Non-market maker financial participants account for 22% last month, double the number 2 years ago. There is also increasing participation from Europe and US, now accounting for 30%. This slide shows iron ore futures market structure, where we can see the most liquid contract is the second and third contract months. The most liquid spread contract is the spread between the second and third contract months, and there is good activity out to the fifth contract month, including the spread between the second and fourth contract months and the spread between the second and fifth contract months. Screen volumes now account for about 55% of the total volumes, with block futures continue to play an important role, facilitated by leading iron ore interdealer brokers. Option volumes account for about 16% of total volumes. In the previous slide, we see that the second and third contract months are the most actively traded, and that 55% of the total volumes are traded on screen. In this slide, we will focus on the screen activity, and we see from the top left chart that screen DAV, or daily average volume, for second and third contract months have grown steadily along with the overall increase in iron ore trading activity. The second contract month accounts for nearly 60,000 lots DAV last month, while third contract month DAV is around 35,000 lots. There is also increasing interest in the US hours, around 20%, as can be seen from the top right chart. Spread trades make up around 40% of screen activities, with bid-ask spread during active trading hours at 5 to 10 cents or 1 to 2 ticks. Market depth is over 500 lots or 50,000 metric ton, while quoting size for best price is around 25 lots or 2,500 metric ton. Now, in this slide, we will see a few charts showing the relationship between iron ore and other related commodities relevant to the virtual steel mills concept. The top left chart on hot metal spread shows the steel production margin, representing the pricing differential between the steel output, in this case using rebar, and the raw materials, iron ore and coking coal. The concept is similar to the concept of oil crack spread. The top right chart shows the relationship between iron ore and coking coal, and the bottom left chart shows the iron ore relationship with FFA, in particular the Capesize route C5 from Australia to China, which is the iron ore route. Last but not least, the bottom right chart shows the relationship between the price of the higher grade 65% and the benchmark grade 62%. These charts can be useful to monitor for potential trading opportunities across different products or markets. We are now reaching the last slide of my deck, which shows the option market structure, which could be of interest to those of you who are also keen to trade iron ore option. Currently, iron ore option account for 16% of total volumes, and majority of them are blocked via interdealer brokers. Typically, block size would be minimum 500 lots, with bid-offer spread of around 30 to 40 cents. We also have market makers quoting option on screen to complement the block options for traders wishing to trade on a smaller size on screen. Okay, that's all I have for today. Hope it has been a useful session for you. Should you have any queries, please do not hesitate to contact us at the email address shown here.
Thank you for joining this session. My name is Gary and I'll spend some time talking to you about our FX futures offerings from the Singapore Exchange, or SGX in short. SGX has a suite of equities and commodity derivative products where our FX futures provide participants to hedge currency exposures as well as to use these currency futures to express and take positions based on their views on currencies. You might expect our focus is on the Asian economies, where other flagship products include the FTSE A50 Chinese Equity Index futures as well as iron ore futures. Today I'd like to talk about our top two most liquid FX futures, the dollar CNH futures, which is a US dollar against the offshore Chinese renminbi, as well as the Indian rupee against US dollar FX future. The symbols for these contracts are UC and IU respectively. These two futures provide participants with exposures to the two largest economies in Asia. These two economies have also been in focus, particularly this year, with India seeing a surge of foreign investments in both equities and bonds, and a growth in using the Indian rupee contract to hedge their assets, FX risk, as well as speculative risk-taking. We have recently seen a record open interest of $7 billion in the month of May and a single-day record volume of $5.5 billion. We have also seen participants trading the Indian Nifty Equities Index contract hedged into the Indian Rupee FX contract. Similarly, with interest in the Chinese economy, we have seen many participants come on board over the past year, hedging their FTSE A50 equities and iron ore exposures with our CNH contract. Other traditional participants who have been primarily using the OTC FX have also been new entrants over the past 2 years, moving to trading listed FX futures as it presents a more capital efficient and transparent instrument. The CNH contract recently saw a record open interest of over $20 billion in May, while we saw a single day record volume of over $22 billion last December. In the listed FX space, SGX's two contracts are within the top 10 most traded FX futures, and we expect our rankings to improve this year, with Indian Rupee trading almost $2 billion a day and CNH trading over $12 billion a day. The exchange has seen a huge CAGR growth in both volumes and new participants. We are the leading Asian FX exchange in the world, with an open interest of close to $27 billion in May 2024. I'll speak a little about our Indian Rupee futures, where it is an important contract, particularly to the Nifty participants, as well as some of the institutional FX traders who hedge into our venue. The Indian Rupee contract was launched in 2013 and has grown significantly since then. In May 2024, it has averaged a daily volume of over $2 billion, with May's month-end record open interest of 291,000 contracts, which is roughly $7 billion. As with all listed contracts, liquidity and bid-ask spreads are of the utmost importance, and given the diverse group of participant mix and volumes across Asian and after Asian hours, the top of book spread has remained consistent. In May, in both the T and T+1 sessions, it has been less than 1 basis point, with an average size of 100 contracts at the top of the book. As an exchange, participants enjoy cross-margining efficiencies. Besides other currency futures, India-related derivatives also enjoy significant margin savings. Some participants also employ strategies trading the Indian rupee against the Chinese yuan, negating the expression of the US dollar, where there is a 44% margin offset. Here are some statistics that are useful to highlight. In the top right chart, as the Indian rupee contract is a month-end expiry contract, you'll notice participants start rolling their contracts in the middle of the month, approximately 10 business days before expiry. The open interest is significant, and it does take some time for all those positions to roll over. In the bottom left chart, we give a breakdown of the contracts traded during the months of March, April, and May. Essentially, 60% of the nearest contract will trade during the month, and 40% of that would be of the second month. Liquidity in the rupee contract resides in the first two contract months. If you take a look at the bottom right chart, this is an hourly distribution of how the contract trades during the day. These are in Singapore, Hong Kong time zones, and you'll notice that the volume starts picking up at 11 o'clock when the onshore Indian market opens. Volume picks up again at about 9 p.m. to midnight when London and US activity sees good trading volumes from non-Asian funds. Now I'd like to talk about the dollar CNH contract, or UC for short. CNH is also known as the offshore Chinese renminbi, or Chinese yuan. This distinction of offshore versus onshore renminbi is key, as the Chinese currency is a controlled currency that is not freely traded offshore. In FX markets, the onshore renminbi is denoted as CNY, while the offshore renminbi is denoted as CNH. The contract reflects the price of $1 against offshore Chinese yuan. The dollar CNH contract was launched in 2014 and has grown significantly. 4 years ago, in 2020, it was averaging $4 billion volume traded daily. It has since grown, and in May 2024, the daily volume is about 12.5 billion US dollars. The single day record volume stands at 222,000 contracts traded in December for a notional of 22.3 billion US dollars. While open interest was established at a high on the 31st of May, it stood at 20.3 billion US dollars. Key to the contract's growth has been the adoption of listed FX futures by banks, asset and fund managers, commodity traders, and other traditional OTC participants who use listed futures for capital efficiencies, lower margins, and price transparency. Besides the usual hedging demand and systematic strategies, many banks have started hedging their CNH currency exposure via SGX FX futures and hence made this contract the primary source of price discovery for dollar CNH. The spreads in the contract are extremely tight, and on an average, about 9 contracts are on the top of the book across sessions. Even after Asian hours, the bid-ask spread is below 0.3 basis points. Pricing and depth of book is consistent across with the diverse set of participants engaged across all hours. Besides margin savings against the FTSE A50 contract, participants also enjoy savings in the China H50 and Taiwan Equity Index futures. Calendar spreads trading in dollar CNH is also a fairly popular trading strategy, and participants enjoy margin savings of about 80%, where one outright contract requires a margin of CNH 12,100, which is about US dollars 1,700 for a $100,000 contract. A calendar spread contract will only require CNH 2,300 or about US dollars 320. The dollar CNH contract's most actively traded contract is a quarterly IMM contract, which are the months of March, June, September, and December. When you look at the distribution of traded contracts in the bottom left chart, it shows that in March, 34% of volumes were the March contract, 15% in the April contract, and 43% in the June contracts. Following on in the month of April, 68% of trades were the June contract and about 4% were the September contracts. The contract expires mid-month and expiries then to be rolled 10 to 14 business days before expiry. The top right chart shows open interest, and it's a very stable open interest in the month for the contracts of June, July, August, and even contracts beyond September, while the May contract expired on the 13th of May. The bottom right chart gives you color about volume distribution through the day with the activity across 9 to 11 a.m., 2 to 5 p.m., 8 to 1 a.m. Singapore time. You'll also notice the bid-ask spread of the June contract is about 2 ticks throughout the day as well. To wrap up, here are the contract specifications. The dollar CNH contract's notional size is 100,000 US dollars. It trades to the 4th decimal place with a tick value of 10 CNH. Asian trading hours are up to 5:55 p.m. with a 20-minute break, and the T+1 session starts again at 6:15 p.m. The final settlement price is based off Bloomberg's BFIX at 2 p.m. Singapore time and is cash settled in CNH. For the Indian rupee contract, the contract size is 2 million rupees, which is about 24,000 US dollars. The last trading day is 2 business days prior to the last business day of the month, and hence it is a month-end contract. Asian trading session closes at 7:30 p.m. Singapore time, and thereafter the T+1 starts at 7:50 p.m. The final settlement price is the same as the OTC NDF fixing referencing the FBIL or the RBI's official dollar India spot rate. The Indian rupee contract is cash settled in dollars.
Hello everyone, I'm Michael Reilley from the Training and User Experience team at Trading Technologies. Today we're looking at how using TT and specifically Autospreader allows us to incorporate the FX contract from the SGX, specifically the UC contract, to trade different spreads, specifically cross-exchange spreads with products that are priced in different currencies. If you're unfamiliar with Autospreader, it allows you to create a spread instrument within TT, which can be made up of multiple legs, and once it's configured, you can then attempt to buy or sell that spread at a specific price, and Autospreader will quote orders into a leg or legs of your spread, and once the quote orders are filled, it will then send hedge orders into the other legs in order to achieve that spread at the previously specified price. There are variations to this, but this is primarily the example for this particular tool. Now, the spreads that we're going to be looking at, first we'll be recreating essentially a calendar spread from the SGX. So it'll be one contract of FEF versus a second contract of FEF. Really, this is just so that we are able to understand and see how the Autospreader functions. And then we'll be moving on to an iron ore example, which will be the SGX FEF contract versus the DCE letter I contract. And at this point, we'll pull in that SGX UC contract in order to kind of normalize the currencies in these particular spreads. So SGX FEF is going to be priced in USD, DCE letter I is going to be priced in Chinese yuan, and that UC contract, which is the Chinese yuan contract, will be used to normalize this into US dollar terms. We'll then do another example of ICE Brent versus INE SC, so two crude oil examples there, and again using that SGX UC contract to normalize to USD as well. Moving over to our workspace, in the upper left, we have a market grid. We can see a section for crude oil, followed by iron ore, FX, and then Autospreader down below. So we have some prearranged spreads that we created ahead of time. Then down at the bottom, we have the Autospreader widget, which will contain a list of the instruments that have already been created and are available to me. And from here, we can launch and so forth. Before we go any further, just to note, if someone is going to be placing an order on, let's say, this FEF July 24 contract, they can click on the bid or the offer, and that would bring up the order ticket. Quantity, price can be defined, and then we can click buy or sell to submit that order. I would also note, as we will be seeing the MD Trader quite a bit, that I could open up the MD Trader here, and very quickly, this is a static price ladder down the middle. We have the bids in blue on the left, the offers in red on the right, and then we have a working order column that would display any working orders that we have currently working in this market. Now, I have a quantity field here, and let's say I populate that to a 5. I can then click at a price of 106, price level of 106.75, and I click in the blue, so that is a buy order, so that is a 5 lot working at that particular price. Okay. On the sell side, if I click on the red at 107.30, that is now a sell order at that particular price. So when we describe Autospreader and we walk through this, we'll be placing some orders, and that's kind of the representation of where those orders are and where they are re-quoting to. Now, if I wanted to begin and create a spread, let's say for that calendar spread, we can go to this iron ore section in the FEF contracts. I'm going to click and drag from July to August, and that's going to select these two particular FEF contracts. I can right-click, create Autospreader widget, and that will send those particular contracts into our Autospreader config, and we can begin to configure our spread. So first at the top, we're going to name that particular spread, as we will need to name it and then reference it later on. So we name that spread, and we're not going to go through all the features of Autospreader just for the sake of time, but I would note that there is an equation here which we'll come back to and modify later on, but it's currently grayed out. We do have some preset equations to build our spread with. In this case, we are essentially just looking at leg 1 minus leg 2, and if we look at the bids and offers here, 107.25, 106.85, we can see that our mock MD Trader on the right here is approximately 45 cents. So we can see that our prices are lining up so far. I'm also going to uncheck the active quoting box on the August leg in this case, just so we can walk through this and see this clearly. So from here, I can go ahead and save that particular spread. And I'm going to go down to Autospreader down at the bottom here. And I have two buttons. One will pull up that same config that we looked at a moment ago. And I've got a launch button here, and I'm going to open MD Trader with the legs. And this will open up 3 MD Traders. It'll be the Autospreader on the left, it'll be leg 1 in the middle, and it'll be leg 2 on the right. Now, what we are able to do here is in that Autospreader leg, I'm going to place an order at a price of 20 cents. And that is a 1 lot to buy that spread at 20 cents. Now, when that Autospreader order is placed, a buy order will go into our quoting order where we set a moment ago, and that quote order is going in at a price of 106.90, and it will re-quote based on the liquidity in leg 2, in this case at the price of 106.70. So theoretically, if this order, there was a large sell order that came through, and this order were to get filled, we would be able to then sell at a price of 106.70, and that would achieve our spread of 20 cents, as 106.90 minus 106.70 will give us that 20 cents. That 20 cent difference. I'm going to go ahead and cancel that for now, And the next spread that we're going to look at will actually be that iron ore spread that we mentioned a moment ago. So if I go back to my market grid, I'm going to click on FEF SEP 24. I'm going to hold control, so I'll be able to select multiple instruments from different lines here. So FEF SEP 24, holding control, I'm going to click on the letter I contract from the DCE, and I'm also going to click on the UC September 24 contract in the FX section here. Now, right-clicking, again, going to create Autospreader instrument. And this will load those three contracts into our Autospreader config. So again, we're going to name this spread, and as we will need to reference this in a moment. However, as we have this loaded up here, we'll look at that MD trader, the mock MD trader on the right, and negative 709.87 doesn't really give us a whole lot of information. It's not really the price that we want to be, viewing this spread in. So we need to make some modifications here. So I'm going to go back to that price differential drop down here, and we don't want to use this exact leg 1 minus leg 2 plus leg 3 equation here. So I'm going to go down to custom, which allows us to modify this to whatever we feel is appropriate. And what we want to do is we want to get this letter I contract into USD terms so that we can trade a USD contract versus a USD price contract. And in order to do that, we're going to put some parentheses on here, and we want to divide the prices of letter I by the UC contract in order to get this into dollar terms. All right, so we've modified this to essentially leg 1 minus letter I, the prices of letter I divided by third leg, which is going to bring this into US dollar terms. And we can see in our MD trader on the right, it's now priced at negative $7.77. Now, we're not going to go through all of these features again, as I mentioned, but for active quoting, we are going to want to modify this. So we're not going to quote on the letter I or the UC contract, and that's specifically, letter I, the INE and the DCE, they have limits as to how much requoting they can do within a particular session. So we're going to uncheck those active quoting boxes. However, we are going to check the enable hedging boxes so that if we are filled in the FEF contract, we do hedge into the letter I and into the UC contract. Now, again, in that mock MD trader on the right, we don't see any bids or offers. So we do want to modify the tick size in this case. So I can click the override tick box here, and I can change this to 1/20. The reason it's 1/20 is that if we were to launch these MD traders, we can see that our UC contract has 4 decimal places. The letter I has 1 decimal place and trades in 50-cent increments. And then our FEF, which is what we're going to be quoting in, is quoting in every 5 cent in 5-cent increments. So we can set that override to 1/20, so 5 cent, and then that 5-cent increment will be displayed on our ladder accordingly. So I can go ahead and save that config. And now going down to the Autospreader down below, I can go down to our instrument. I'm going to use our launch button here. I will open MD Trader with legs. And as that opens, I'm going to get this on screen for us here. There we go. Again, we will have the Autospreader MD Trader on the left, followed by leg 1, followed by leg 2, and then the UC contract leg 3 on the far right. Now again, I can go and I can place a buy order at negative $8 in this case, and we can see that we have a working quote order at 105.85 in leg 1, and that is going to be leaning on that letter I contract and the UC contract on the far right. And it doesn't have the same easy math as we had in the like-for-like contract, but nevertheless, as these markets move around, it will re-quote leaning on the letter I contract and the UC contract, and essentially letter I divided by UC contract. In this case, if I were to move this order a bit higher here, we can actually move this right across the market just to simulate a fill. And as that fill comes through, we can see that we got filled on our FEF contract at 106.30. We were sold at 823.5 on the letter I, and we bought the UC contract at 722.38. So we're also going to take a look at that crude example. So going back to our market grid, we can see the crude section at the top, and I'm going to select the BRN SEP 24. I'm going to select the by holding Control. I'm going to select the SC SEP24. Again, we're going to incorporate that UC SEP24 contract down below. So I'm going to select those three, and with a right click, again, I'm going to create Autospreader instrument, and let's make this a bit bigger here. So we can see our three contracts have already been loaded up. We're going to name this again. And once again, it will default to that price differential equation, leg 1 minus leg 2 plus leg 3. That's not quite going to work for us, so we're going to have to customize this. Again, we'll add those. We will add those parentheses and divide leg 2 by leg 3. And we'll see that our spread in our mini MD trader here is already coming a bit more in line here. So as we look at some of our settings here, we do want to again note that we want to uncheck active quoting on the SC and the UC leg. Again, regulations on how much quoting we can do on the SC leg there. And then we do want to set enable hedging both for SC and UC so that our currency exposure is offset as well. In the lower right, I am going to override that tick size. So the UC leg has a number of decimals, so we've got, by default, the calculated version is going to be 1 over, is that 10,000? But we're going to be quoting on that BRN leg, so we'll be doing 1 over 100 in this case. You can see that the synthetic Autospreader bids and offers somewhat come into line now. I'm going to go ahead and save that spread, and then in the lower Autospreader section down at the bottom there, I've already got a version of this same spread created. I'm going to click the launch button, again going to open MD Trader with legs, and let me pull all of these on screen for us. Here we go. Okay. Now once again, Autospreader MD Trader on the far left, leg 1 or the Brent leg will be second. Third will be that SC contract. And then on the far right, we have the UC SEP24 contract. I do note that I have a 1 lot in that contract, a position of 1 in that contract already. I'm actually just going to click out of that position. That's from the previous spread that we looked at a moment ago. Now in that Autospreader MD Trader on the far left, I'm going to place a 1 lot order at a price of $1. Now we can see that our quoting order has gone into the Brent September 24 or leg 1. And that's going to requote, again, based on leg 2, the SC leg, divided by leg 3, the UC leg, and it will continue to requote based upon where the liquidity is in those 2 legs. All right. So if we move this order up, I'm just going to drag the order across here to simulate that fill. Now we're filled. We are now long 1 of the spread. We are long 1 of the Brent September 24 contract, short 1 of the SC, and long 1 of the UC spread as well. All right, thank you everyone for joining. If there are any questions regarding the functionality of TT or Autospreader, please feel free to reach out to us here at TT. Our training team's email distribution is training-ux@tradingtechnologies.com. And thanks again for joining.